If you recall, our corporation in the previous exercise had issued 6,000 shares of $2 par value common stock, along with 80 shares of $100 par value preferred stock. This was 5% preferred stock, and the 5% determines the amount of the dividend that will be paid to the preferred stockholders. Our stockholders will receive 5% of par value, which will be $5 per share. We did have 350 shares of treasury stock, though, as well. And these were common shares that the corporation had purchased and was holding in the Treasury Department. Treasury shares do not receive dividends when they are declared because logically the corporation can't pay itself a dividend. So Treasury shares do not participate in dividend payments. Our corporation here in Transaction A declares the cash dividend on the preferred stock. Remember, that was $5 per share, along with a 10-cent per share cash dividend for the common stockholders. Remember that the preferred stock dividend must be paid before the common stock dividend can be paid to the common stockholders. Since we have a $5 per share dividend, and since there are 80 shares of preferred stock outstanding in the hands of stockholders, then we'll be paying those stockholders $400 total in dividends. Our common stock receives a 10-cent per share dividend, but there are only 5,650 shares of common outstanding. The Treasury shares don't participate in the dividend, so that will be $565 that the common stockholders will receive. Our debit goes to an account called cash dividends. But this is just a temporary holding account, and eventually the cash dividends account will be closed into retained earnings. The retained earnings account represents the earned capital of the corporation, and under legal capital laws, if there is any debt outstanding, then the corporation cannot make a payment out of paid-in capital. There would have to be earned capital in the business in order to pay a dividend. This earned capital is recorded in the retained earnings account, and eventually, when cash dividends is closed to retained earnings, the $965 will be taken out of the retained earnings account balance. This represents earned capital that's been paid out to the stockholders. When our corporation declares the dividend, then the dividend becomes a legal liability on the part of the corporation. So we'll be crediting two different accounts here, preferred stock dividends payable and common stock dividends payable, for the amounts that we've declared. When these dividends are paid, then we'll be debiting the liability accounts and crediting cash. These two liability accounts will be current liabilities on the corporation balance sheet until they're paid. Cash dividends are not the only kind of dividend the corporation can declare. Corporations that don't have cash on hand can declare a stock dividend, and that simply means that new stock certificates will be printed up and mailed out to the current holders of the corporation's stock. They receive a dividend in the form of new shares of stock. If our corporation declares a 10% stock dividend, then given the fact that there are 5,650 shares of common stock outstanding, the corporation will be issuing 565 new shares. Every stockholder who owns 100 shares will receive 10 new shares as a dividend. Accounting rules require us to debit the stock dividends account for the current market value of the new shares that are going to be issued. And if our stock is selling for $3 per share currently in the open market, then we'll need to debit stock dividends for a total of $1,695. Later, the stock dividends account will be closed into retained earnings also. So this $1,695 represents a reduction in the balance of retained earnings. The credit will go to a common stock dividend distributable account for the par value of the shares that are going to be issued. Remember, we have a $2 par value, so the total par value of these new shares is $1,130. This stock dividend has only been declared. The stock certificates have not been issued to the stockholders. Therefore, we cannot credit common stock at this time since the shares are not issued. So we're going to park this par value amount in a temporary holding account called common stock distributable. Later, when we issue the shares, we'll be taking that balance out of common stock distributable and putting it into the common stock account. Since the par value of the shares goes into common stock distributable, the difference between the par value and the market value of the stock will be recorded in a paid-in capital account. Some corporations might use a separate paid-in account, but our module uses the same original paid-in capital and excess of par value account that we used in the last exercise. When the stock is distributed, we will debit common stock distributable and credit common stock, and now the par value of the shares will be in the common stock account. Likewise, the number of shares issued and outstanding will have gone up by 565 shares. When it's time for our corporation to close the cash dividends account and the stock dividends account, it'll do so by crediting cash dividends for the balance in that account, which was $965, and then crediting stock dividends for the balance in that account, which was the $1,695. The total debit then is $2,660, and this goes to retained earnings. Let's take a look at our corporation's balance sheet now, and we'll see that the account balances have changed. The preferred stock account is still the same. It's the par value of the preferred shares that have been issued. The paid-in capital on the preferred stock is still the same, but the common stock account balance has changed. An additional 565 shares were issued, which has brought the balance in common stock up to $13,130. Paid-in capital in excess of par value on the common stock has also changed. It's gone up to $6,565. We added $565 to it when the stock dividend was declared. The paid-in capital from the sale of treasury stock is still the same. It's $50, so our total paid-in capital has become $31,745. The retained earnings account is now $17,340. It has fallen by a bit, and that happened when we declared the stock dividend and the cash dividends. The treasury stock account is still the same, $1,400. So when we net it out, what we have left of our free and unrestricted retained earnings is $15,940. Overall then, total stockholder equity is $47,685. This ends our video presentation, and I hope it's been helpful to you.